Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, December 1st, 2021. What we're going to do in this video is keep it focused on the major stock indexes. So we're going to look at two things. We're going to look at the charts of the indexes. We'll focus on the big three I like to watch and trade, the SPY or S&P 500, NASDAQ 100, and then a brief update on the small caps. So after we go over the price action, and I'm going to walk it down from the longest term time frame. We're looking at a monthly chart here. What I'm going to finish the video with are breadth indicators. They're just I can't wait to get to these. There's just a lot there to look at. So let's dive into the charts here. All right, S&P 500 long-term chart, monthly chart. We're still, the long-term trend indicators are still solidly on a buy signal. Just to name a few, some of my favorites. The 20-month exponential moving average, this blue line you put on a monthly chart, does a phenomenal job of defining uptrends when it's trading above it. Remember, these are monthly candles. Nothing matters intra-month. Today's December 1st, so the only sell signal we could get on any of these indicators on this monthly chart would be a month from now, January 1st, once the month is closed after or the end of December 31st, last trading day, whatever that's going to be this year. That's it. So you cross down and then boom, new downtrend starts. There was a 50+%. I think it was a total about 55% bear market. Crossed back above it. Trend went to bullish. That was a buy signal, and so forth and so on. Oh no, I'm sorry. That was back in 2003. Yeah, there's our 57% bear market in '08. That was the previous one. Again, just a phenomenal job. You come down and test it sometimes, and usually close. Even if you pierce it intra-month, you'll typically close back up on it, and that's what happened there. So that's it. You can see real tight, nice and tight. We're still above it. And then I also one of several others is the PPO histogram. Talked about that one quite a bit. Does a bang up job of defining bull and bear trends. That's this red and the green lines when the PPO lines are, or when the PPO line, which is this blue line, is above the white line, which is a signal line, you're going to have a green histogram. When they cross, we go above or below the zero line. So again, usually early on in bull markets, you're going to get a bullish cross after a bear trend, and then that tells you the trend is bullish, and you get a little correction. That was, I didn't measure that one. I can tell you right now that was a double-digit drop back then. That was the Asian contagion back in 1998. And so forth and so on. So you can see all the crossovers, all the bear trends, bull trends, and you can see right now we're still solidly in a bullish trend. And that's that. So again, I'll update that one infrequently. That usually only cover the monthly charts every so often. We drop down to the weekly chart. What do we see? You can see the same thing. We'll go back here. We'll scroll back to about, we'll go back to that last bear market again, what do they all have in common? All these big drops here. Divergent high, 51% drop. Divergent low right there in bull market that followed. Divergent high, 57% drop. Divergent low at that low right there led to this, really this whole bull market started with this divergent low right now that we're in. And so forth and so on. But again, the common theme here, common element, are for corrections. When you're in an uptrend, that's what you're looking for. You're not looking for a bottom, so you look for those with after big drops, and that's where we're at. So divergent high, 22% drop, divergent high, 15, and another 15% drops off the two divergent highs, 21% drop off that divergent high, 36% drop off that divergent high, and this one's going to be a doozer. We've gone not vertical or parabolic, but it's certainly a sharp uptrend, and the divergences continue to build. So that's that. Take it down, walk it down to the daily chart. I'm looking at this trend line. I'm not crazy about the trend line, but it's one that I added recently. Comes off the March of 2020 lows when COVID first hit and took the S&P down, and you come in recently, you grab some of those reaction lows back in September, early October right there, and that's where we're at now. But more importantly, you also have, just like you had back here, divergent high for this drop, and that was the biggest correction in months. We pushed up, and as at the time I talked about it, we had some major sell signals I should say, on the markets back then, and those sell signals I still have maintained are intact, because when we went down I said, well, look, we could go on. I could see the possibility or the potential for a marginal new high, and that's exactly what we had. We had about a 3-4% marginal new high above there. Now what we need to do, and I think we're going to do it, is take out that previous high, because remember, this was a breakout to new all-time highs right here, and on face value, and unless that fails, that is bullish. But as I often say, fewer things in trading are more bearish than a failed long side breakout, because you get a lot of new money comes in, buys the breakout, and then once they realize the breakout has failed, stops are hit. That's where I can tell you right now a good cluster stops will be hit. And so I think we're about to get the party started. I'm going to show you something on the NASDAQ 100 in a minute here. I think you'll like, especially if you like shorting. Alrighty, SPY, this is our 60-minute chart. Remember, we've been on a sell signal since before I went on vacation back last week. I was out all last week. We had this sell signal here, number 1 right there, and then pushed on, again, made that marginal new high, sell signal number 2 there, and we've been stair-stepping lower. So, you know, in its simplest form, we are in a near-term downtrend. There's no arguing that. There's a high. Downtrend is defined as a series of lower highs and lower lows. And so I believe we're headed lower from here. And as I mentioned the other day, I came back on Monday and said, look, we were right there in the morning when I did the video. Said that's an objective shorting up because we were on a sell signal, and you want to short these rallies back into resistance. The resistance was this gap right here, and boom. So perfect entry when I did the video. We ran up again, tested that 465.47 resistance I laid out on Monday, and boom, another objective short entry up towards there. Now I always say you want to, you know, if you're, especially once a downtrend starts to get traction, don't hold out to the actual resistance level. Short a little shy of that. I did the video, we were a little bit above it, and that was fine. I said you could scale all the way to the gap or short right here. But on that snapback rally, and my logic is, my experience is, you get a lot of trap longs. You know, the dip buyers, it's a great strategy in a bull trend, and you know, you're a genius if you buy every dip. It's not rocket science. And but this is where we start to get that rut row moment, or what I call the POR, point of recognition, where they realize, oh, bought that dip. Ooh, that hurt. I'm down here. Okay, we went up here. Ooh, bought this one too. And so what happens is you have a lot of trap longs that want to get out. You also have a lot of what I call wannabe shorts that didn't have the gumption to short here because they thought the trend was too strong on that sell signal or the previous one over there. But now they want to get short. However, the market doesn't make it easy on the masses. So those that are trapped and want to get out and want to bounce back to resistance, or shorts that want to short, will often, you'll see things quite often reverse. Not to say that we couldn't hit that level or couldn't have went up and backfilled the gap, just that that's what happened, and that's what typically happens. And more so as it becomes, again, as it becomes more clear to the masses that the trend is now bearish instead of bullish. At least, again, remember, I speak near term. We're on a 60-minute chart. I'm talking about the near-term trend now, which is measured from my, you know, typically I measure that in days to weeks. And the long-term trend, as we start out with on the monthly chart, that's measured in months or years. And so that trend's still clearly bullish. All right, now let's move on. Let's go to QQQ. We'll walk it down from the weekly time frame. No reason to go to monthly. The sell signals, or I'm sorry, the buy signals are still well intact on the monthly as well. Of course they are, because we're not far off all-time highs right there. But all right, so here's what I have on QQQ. You can see a primary trend line off the lows. The S&P 500 bottomed back in March of 2009, as did just about every other index, but the NASDAQ 100 actually bottomed back in November of 08. So either way, you want to call it roughly a double bottom there. But there's your primary bull market uptrend line, and we're still well above that. Now, why am I bringing that up? Well, I think that's where we're going to go and visit. When you get these long-term trend lines, every so often you go and visit that trend line. I also have an alternative trend line here, this blue one right there, and they come in roughly together. So, you know, as far as a longer term target, at some point, whether it's this year, well, not this year, that would be most likely if we're going to hit it in next year, 2022. Who knows? Maybe the following year we can go up like this. You know, it's still going to be there even if we go higher. I'm just pointing out a likely target, and I think we'll also come in right around here. I'm going to give you another line here. Again, this is long-term stuff. But about 235 right there, we have a major reaction high. And above that, the next support is 268.30. So this would be, well, you can see all three targets. 1, 2, 3, I'm sorry, 4. We're talking about a 13-14% drop. That's my minimum target for the next correction. Again, it's going to take a little bit of work. Right now, we're on short-term sell signals. I don't have any long-term sell signals. So that's one potential target there. If things get rolling. There's about a 25% drop to that 299-ish level right there. Then 268.30 is about a 32% drop, and then the uptrend line and that previous reaction high from back in 2020, just before, early 2020, right before the markets fell off a cliff when COVID first hit, that would take us down about 40%. But again, first things first, we're going to focus on the 60-minute charts and daily charts, and trade our way down long and short if we're going down there at all, at least anytime soon. Alrighty, daily chart, QQQ, get a lot of lines here, but the ones that I'm looking at right now, we have an uptrend line here, pretty clean, at least nice 1, 2, 3, 4, 5 distinct reactions to help validate that trend line. So as far as near-term targets, you've got the 382.80, that's that previous reaction high right there, and then 373.14 or so, it comes right in with that uptrend line. So that's where I'll just say it now. These are my minimum targets from here. My minimum actually was obviously the first target, and that's about another 4% drop. Remember, we've already been on a sell signal. I mentioned it the other day, just to jump back to that weekly chart. Last week we printed a bearish engulfing candle, and as I said earlier this week, we need to see some downside. I don't want, well, you can't see. It's not what I want or don't want. If we take out the top of that candle, then it's no longer a potential topping stick, because that's what a bearish engulfing candle is. It comes at the end of a prolonged uptrend. It engulfs the previous candle or multiple candle bodies. That's all it needs to do is engulf the bodies. So you engulf the previous two bodies there on QQQ. And now I'd like to see follow through when we get a bearish engulfing candle. So it means the next candle ideally should be red. Remember, this is a weekly chart. Nothing matters until Friday 4 p.m. Right now it's green, but we're basically flat for the week. You can see there's a little doji type candle. And so this has the potential to confirm this potential sell signal. Again, I call it a potential sell signal or topping candle because I need to see that evidence. Now we could round around this week and then close red again, as long as we don't violate the top of the candle, and I really don't like to see us go up much above the top 2/3 of the candle or so. And again, I'm kind of looping back on the weekly just again to mention in this video, as I mentioned the other day, we wiped out the previous 3 weeks, previous 3 weekly candles on SPY with last week's bearish engulfing candle. So there it is, work to be done. Let's get back to QQQ and I'll wrap it up and get to the breadth indicators. All right, so it wasn't just the weekly. As I said, it was also the daily charts on both QQQ and SPY. There's the bearish engulfing candle when I was out on vacation. That was on Monday, first day I left. And or I left over the weekend, but the first day I was out, and we wiped out, you can see the previous 2 candles there, and that's what you got. You got a red candle, and we've remained well below that candle since. And so that is confirmation. That's solid check marks on the daily time frame. And again, those sell signals came after the sell signals that we had here on the trend line break, and then also that secondary trend line break right there. So we have multiple sell signals. Yeah, one of the strongest trends in years. Do what you want. I'm following the charts. These sell signals are as valid as I've seen in a while. Doesn't guarantee they're going to work out. They're just multiple sell signals, and they also came after divergent highs, just like we had a divergent high right there when the last correction came. We also had sell signals on that one, and we're short that one, and we dropped 9% or so in QQQ. All right, so those are your targets, and again, first target's only about another a little over 4%. Next target's about another, gives us about another 7% downside to that trend line. And then depending on if and as we get there and how the charts develop over the next week or so here, then I'll make a decision to either, cover shorts, reverse. I mean, you guys know me, I'm actively trading all the time. And gaming, bounces off initial support tags of support levels. 390 is a big one right there. We've been hitting it. We hit it right there. We had some reactions there. And as I mentioned the other day, that it will trigger most likely a drop down, and probably a pretty impulsive one down to my first target, second target, third target zone, fourth target there. Those I laid out before I left town when we first got the previous sell signals, this one and this one on QQQ. All right, and so now what we're going to look at here is this price action right here. So you can see we're bouncing around. That's where I did the video the other day and said it would be an objective short on a bounce back to 401 right there, because that was resistance, or around 400 we'll call it, and that's exactly what happened. So you had we've had 2 failures there so far, actually 3. So 3 objective shorting ops, or you know, where you can add on or get back in if you game to bounce off that support, and it's probably going to be the last one in my opinion. Now, if we break it, that's nothing but bullish. It doesn't mean we're going to rip to new highs and beyond. We could, but those are the levels I'm watching. That's all I can tell you right now. We're smack between support around 390 and resistance around 401. And when you get these areas of consolidation, it often acts as like energy, like a coiled spring, and so a solid break. When I say a solid break, it means anything but a little whipsaw move above and back down into it. A solid break above is typically bullish, and a solid break below is bearish. Indicators, everything else that I've been looking at recently, tell me we'll probably get that downside break, and that's why I'm still maintaining these price targets. And again, if we do, it could be a pretty swift move down. You can look, I think you can see it on the video. If you don't have a bright monitor, you might not, but these are the volume price histogram bars that go out all the way to there. Then you have a bunch out here, and this is what I call a thin zone right here, where you had very little trades took place. It was only this little rip right here on that breakout that was above this previous high. That was an all-time high back here. Market, or QQQ, tested, popped it, and it was a quick run up. And so these thin zones tend to work a lot like gaps, where gap you don't have any trades that went on, but in here you had very few. In other words, very few people bought. That's why you usually get that swift move down once that level goes 390. And let me show you something on the futures real quick. Let's look at NQ. All right, so we're looking at, this is a 60-minute chart, same one I've been highlighting recently. There was our first divergent high, our first sell signal right there. We dropped, put on the margin, made the marginal new high, little snapback rally, and then took out the secondary trend line. And again, this is that level of consolidation we've been working on. There's an uptrend line and price support about 15,931. We'll probably head down to, and or any of these other ones. But I'm going to jump back here. Let's take it out to about 6 months price history and look at 2-hour candles. And here's what I want to show you. So after a top, even if, again, don't mistake a top. When I say a top, I'm not talking about the top. This one could prove to be, any top can prove to be, you only know that in hindsight, but tradable top. And those tops, things I like to look for, divergences, for example. That's not what I wanted to do. You can see they're labeled divergent high, because I think that carried through on the 60-minute charts. We're now on 120-minute candles, but again, you had a divergent high there. There's your trend line break, nice wedge. So what happens is you had an impulsive move down off the divergent high. We've been consolidating. Back here was our last divergent high and sell signal. We had divergences building. That's not what I wanted. Here we go. There's our divergences, divergent high. We had a sell signal back there. And what happened after the initial move down is we had this little level of consolidation. Now, yes, it looks much smaller, and it was. Volatility is expanding. We have more volatility now, and that's why I'm expecting a bigger move out of this. But you can see there, if you zoom in nice and tight, let's do that. Take it in a little tighter. You can see what happened after we broke that consolidation range. We put in the divergent high. We had an area of consolidation there with the divergent high. Drop down, set up another area of consolidation, and guess who won that battle? Well, the bears won. And when they did, you had a big move down. So this is what you need to get ready for. And so again, if that support level on the Qs go, or the recent lows on futures are going to show that spike low that we didn't have on QQQ because of, remember QQQ, you're seeing the trades 9:30 a.m. to 4 p.m. So this is really the level right about here that needs to go on NQ. And one other thing, and then we'll move on to those breadth indicators. Let's look at this. Here's a nice little potential head and shoulders pattern. I need to name it. Notice this today. Left shoulder. Call this, that's the head. And then there's a right shoulder. That's it. And so that's what it looks like there. Right here you had a divergent high and there was that drop, last correction, again better than an 8% drop. And so here's what we've got now, a nice left shoulder, potential head. And what I'd like to do is use the, confirm a head and shoulders pattern because it is one of the most commonly recognized patterns in technical analysis. And I think quite often traders jump all over them. One of the things you should do is scrub it for volume criteria, and by definition, a head and shoulders pattern should have increased volume off the formation of the head, meaning the drop off the head down to the neckline. This is our neckline, and then also off the on the formation of the right shoulder, and that's what we had. You might not be able to see my volume lines. I have them turned down, my volume bars, but we did. We had a nice spike in volume here on the formation of the head, and also recently, so volume's picking up. So that's it, and there's your neckline. So the way this works, so head and shoulders pattern is a break of the neckline. It triggers a sell signal for that pattern. Remember, again, we had divergence. It's also marked here, which I like to see very much at the head. And the measured target, simple stuff. You can pull out your calculator, but to me that's a waste of time. You just draw a trend line from the head to the neckline, the longest point in the pattern. Be about right there. And then add that to where the pattern breaks down. Probably going to, if it breaks down, probably break about right there. And look at that. It never fails to amaze me that when I put a measured target out, it comes in where I would have had a price support level anyways, give or take. And that's it. So you had nice reactions here, reaction high there, a lot of reactions there, big old gap right there. So that's a pretty valid trend line there, about 370, 376. So if you want to just swing trade, get a hit and run trade out of this, that would give you, if that target's met, remember cover a little bit above it, you're talking about a 5% drop. Doesn't sound like much, but if you're an active trader and you're trading things like futures, that's certainly going to put a lot of pennies in your pocket. That is. Okay, now we're into the breadth indicators. I've got a ton of them, but I'm not going to go over them all because they're all pretty much going to show us the same thing. So I'll pick a few here and wrap this up. And again, this is so important. I always say it. I know I sometimes might sound, when I start talking about breadth indicators, market breadth deterioration, divergences, and all that, I might sound like Dr. Doom's assistant. But remember, I always say this: divergences and or things like breadth deterioration, market internals, deteriorating, are not, and I repeat, are not sell signals, not even close to it. They are just merely indications of likely you're going to likely see a trend change, a correction, or same thing on the flip side. After a bear trend or bear market, you look for improvement in market internals, positive divergences. But then you need the buy signal, because the divergences, number one, they can last for a long time, months, even years, depending on which time frame you're looking at. And number two is there are times, it's certainly the minority, but there are periods where you have divergences or deterioration of market internals, and they just dissipate, and then everything picks back up. In other words, the divergences don't play out. Again, that is not very often. We don't see that very frequently, but it does happen. So, all right, let's go. And now the takeaway on all this: if they're not sell signals, Randy, why you bother looking at them? Well, it helps to formulate when you start to get maybe a little what seems like a minor sell signal on a 60-minute chart. If the charts are stacked and you have divergences and other things such as clear market deterioration of the market internals, it may help you decide to hold on to that short position or stay out of those longs if you don't short the market for a much deeper pullback. In other words, if everything looks pretty healthy and you get a sell signal on the 60-minute charts, you might go for a quick 5, 6, 8% pullback trade on the NQs or QQQ. Whereas if everything's aligned, you might then hold out for a double-digit drop in the market or a double-digit rally if it's bullish. All right, so let's get through this a little quicker here. All right, so what you have here up top is the NDXE. That's the equal weighted NASDAQ 100 ratio against the NASDAQ 100. So what you have there are 100 stocks in the NASDAQ 100, as the name implies. Those are the 100 largest companies in the NASDAQ composite. And as most of us probably know, and if you don't, QQQ tracks the NDX NASDAQ 100. It is a very top-heavy weighted index. You have the elite $2 trillion companies in there, 2 trillion plus, about 2.5 trillion, Apple and Microsoft, and then you have Amazon coming up close to that, about 1.8 trillion, Tesla 1.1 trillion, Facebook just under a trillion now, and it's a cap-weighted index. So they're going to their returns, what those stocks do, have a much higher impact on the overall return of the index. So when you use equal weighted, you strip out. It is a way that I like to get an idea of what market breadth is. In other words, if you have the NASDAQ 100 going up like this, but you have the equal weighted flattening out, or even going down at the same time, what it tells me is out of the 100 stocks in the NASDAQ 100, a lot more are falling than rising, more so. That's the only way the NASDAQ 100 equal weight is going to go down, right? It's equal weighted. And when you see those kind of divergences, that is a red flag, and those are usually signatures of at least a near term and quite often a major market top. And so what you want to see in a healthy environment, you want to see this ratio going up, and then all of a sudden when it starts going down, that's when usually the corrections come. You can see it going down here. There's some other indicators I'm going to get to in a while. Lately it's just been falling really sharp. Remember that big drop we had when COVID hit and the S&P dropped 36%? You could see the deterioration. And you can do this also with the S&P. They have an equal weighted index. You can do the same thing. You'll see similar charts. But again, healthy rally, healthy market conditions, the ratio is going up. That means more stocks, the majority of stocks are participating in the rally. And when this ratio is dropping, again, you saw a lot of that when that last bear market hit back in October 2007. You could see it dropping there, the ratio dropping again. Then the market finally peaked in October of 7. So the drop started here, way back in, here's the time, late spring of 2006. The ratio was falling, and then it finally manifested in a top. First drop, second drop. You can see that. We had a little participation, started to fall again. All right, so you got that. I'll let you replicate and study that chart on your own. The other things that I have down here, these indicators are the percentage of stocks trading above their 50-day moving average in the NASDAQ, as well as the percentage trading above their 200-day moving average. So the little line in the middle right here, that's the 50 level. That means half. If the indicator is at that 50 level, it means half the stocks are above their 50 and half are below there. And in this case, half are above the 50-day and half, or 200-day, and half are below. So you can never have 100. Obviously, this indicator needs to be bounded by 100 because you can't have more than 100% of stocks trading above or below anything. So that's where you can see the high ends of the range. Now, what I'm looking at, you can see these shaded boxes down here. You can see it here on the, I have them colored up on the NASDAQ, the 50-day. But you can also see down here on the 200% of stocks above the 200, it's a really nice indicator. When it crosses down below 50%, that coincides with big drops. I didn't color this drop up. Look, see, crossed again below it in that bear market. We had the first bear market rally, then it crossed below it, and it's just done a great job of saying, hey, something's going on here. Because again, we're just off all-time highs in the market, in the NASDAQ, especially the NASDAQ 100. We're spitting distance from all-time highs still right now after the correction we've had over the last week or so. However, you can see that only 28, what is that number, 28%, and this is an end-of-day chart, so it's going to be lower today, only 28 or 1/4 of the stocks in the NASDAQ 100 are trading above their 200-day, or 3/4 are trading down below their 200-day, and also it's about the same number there, 24% above their 50-day, meaning the other 76% are down below their 50-day. And again, you can see when you cross that line, just look what happens. These don't look like big drops, and this is the NASDAQ 100 right here. They don't look like big drops, but these are all double-digit corrections, double-digit plus. And that one, again, that was, I forget. I know the NASDAQ fell less than the S&P, but it was well into, 30-something%, something like that. Big drop there in the fourth quarter 18. It's simple stuff. Doesn't always work. You had a cross there. It wasn't much of a correction. So nothing is accurate 100% of the time, but it has a pretty darn good track record. So pause the video, check it out yourself, or replicate the chart. One of my favorites. And another one of my favorites, and again, just for really its accuracy, how well it's performed over the years, or indicated, warned us of corrections, and you can use it in reverse for finding bottoms. But that is the NAAD. That is the Nasdaq advancing versus declining issues. So that's what you have up top. You've got the issues in the Nasdaq composite that are advancing versus declining. So when the line is going down, it's showing the number of advancing stocks minus falling stocks. And you're going to expect that during a bear market. But this was a bull market back here. The last great bull ended in 2000, October '07. You can see this is the Nasdaq composite down below on the bottom chart here, and up above is the NAAD. And so that's the signature of the end of a bull market. You had the Nasdaq continued to climb, but the number of stocks advancing was falling. So it means fewer and fewer names. Think Big Apple, Big Fang stocks, Apple, Amazon, Microsoft, and the likes, doing all the heavy lifting. And then it finally, things just crater at that point, because if you think about it, if you have 100 stocks in the Nasdaq 100, well, the NAD is all the Nasdaq composite. That's thousands of issues. If most stocks are falling, it tells you there's something wrong. The economy is turning. The ship is steering. But towards the end of all bull markets, people buy what they love, those earning juggernauts, Apple, Amazon, Facebook, but then they finally break after enough of the rest of the components under the hood, if you will, have already fallen. And again, you can pull charts. I did this today. I went to the top 5 or so of the Nasdaq 100, all the ones I just mentioned, what I call the FANG stocks, and they all look healthy and they're all near at all-time highs. And then I went to the bottom 20, and a lot of those stocks have already broken down, and many are on the verge of breaking down. If there was enough time in this video, I'd cover it, but I think we're getting pretty long in the tooth here. So let's wrap this up. All right, so that's it. And then you can see, after the bear market ended back in early '09, you can see this line was advancing. That's a sign of a healthy rally. You want to see more stocks advancing than declining, and you did. But along the way, you start to see these divergent highs. I have them all marked, and the corrections come. So let's just keep it simple. All the corrections are marked down here. Again, these are the bigger corrections and bear markets over the years, and they each and every one, at least these red boxes that are marked here, which I pretty much got them all, came after divergence. Although I did make a note right here. The first divergence back here, we didn't have divergence leading up to that drop back in 2018, the fourth quarter. We certainly had it afterwards when COVID hit. I pointed that out. There was just about all my indicators were doing the same thing they are now when COVID hit. So while, yes, be a fool to sit here and say it wasn't a black swan event, but what most people don't realize, or at least the mainstream media, it was priced in the charts. We were going to get a correction one way or another sooner or later. That was just the catalyst, and because it was such a powerful one, it was a quick drop. That's why the S&P fell 36% in just a matter of weeks, because of the shutdowns and all that. But market did what it needed to do, and then we all know the Fed came in with the nuclear response. Blah blah blah. All right, that was then. This is now. This is now some of the biggest, steepest divergences. When I analyze divergences, you can have flatline divergence, with an indicator or price make it a roughly equal high, but then you have the one of the indicators diverging against it, or you can have both, which is common, diverging opposite one another, price and the indicators. In this case, this is price of the index down here. Here's our indicator up top. And usually the steeper the divergence or the longer it builds, the bigger the drop. Not always, but anyway, so that's what's likely going to happen. Now, again, this divergence can build for another, if it wants to, it could build for another year or two. Honestly, I don't know. But when you have it in place and you get a sell signal, you need to be aware that sell signal could prove to be the next 10, 20, 30+% drop. Could or could not. So again, this is just going to tell us, it is telling us what I'm trying to tell you right now. Severe deterioration in market internals, and that is, any way you slice or dice it, not a healthy thing, despite the fact the markets are at or near all-time highs. So who knows? Maybe something crazy happens, and then AAD starts rallying, and then if it takes out that previous high, the divergences are burned through, and the market continues higher, and then this proved to be, or again, it's not a sell signal. It just proved to not play out for a trend reversal. But as of now, and looking at the track record on this one, I'd put good money that it will play out eventually, whether these divergences grow for the next several months or not. Okay, again, I could go through all my indicators. I'm going to just do a couple more and wrap it up because they're all going to tell you the same thing. This is the NASDAQ composite right here up top. I'm sorry, NASDAQ composite here on the bottom. And this is the NAA 200R. Again, that's what I showed you on. I had it on the bottom of one of those earlier charts. It is the percentage of stocks in the NASDAQ composite trading above their 200-day moving average. So there's your 50 line. That's parity right there when half the stocks are above and half are below, and and that's what we were looking at before, those cross downs below that level. We're looking at something different on this chart, and that is simple. Again, it's a big part of my trading. I look for divergences. If they're bullish, divergence. So you had a case here that was back in 2002 after the dot-com bubble burst. This is the tail end of that bear market that ended back in late '02. And look at that. You had divergence. So what you had there is, oh wait, I marked that wrong. Gosh, I'm sorry guys. That wasn't divergence because we had lower lows in both. I don't know why those lines are there, so forgive me. I'll have to delete those. I'll do that later. This is the one. We had divergence back in 2008, heading into lows in '09. There it is. There's your positive or bullish divergence that marked the end of that bear market. And you had some along the way there as well on these little corrections. So they're not all marked, but they were there, and that's something you look for when you want to go long after correction. That is improvement in market internals. But right now, we're at the tail end, or what I believe to be the getting stretched on a pretty prolonged uptrend. And so what we're looking for now is negative divergence. And you can see we had divergent high there. We had this drop. Again, this is a long period in the NASDAQ 100. So don't underestimate these drops. It might not look like much just because we had that 55% or so drop back there in '09. That was still a double-digit drop in '04. 2011, biggest correction early on in the bear market there, double digits as well. There were two drops of about 15% or so back in 2015. And again, they were all marked by these divergences. You see them up here. Divergences in the percentage of stocks trading above trading above their 200-day moving average. So in the drop-off, to me, this is what's concerning. Look how steep that descent is. Before we had divergence, but the slope of the line wasn't as much. I mean, this is falling off a cliff here. That tells me that a lot of stocks are crumbling right now in the market, with the vast majority trading below their 200-day moving average. Same thing under the 50-day. Yet the market's near all-time highs. Something's wrong there. And when that happens, usually you're going to have a pretty big drop. So, give you one last one, and we'll wrap up. Here's a chart I made years ago. I don't hear much about it anymore. Then again, I don't bury myself in the financial media, so maybe it's still talked about. But back in the day, years ago, a decade ago or more, for actually decades, there was an indicator called the Hindenburg Omen that was quite common because it had a good track record when whoever came out with it when it originally came out, and it predicted market crashes, big drops. And so what I did is, and that was based on the NYSE. Well, to me, and I think most of you know this, the market-leading stocks, the companies that really just run the market, even in the S&P 500, they're tech companies. So to me, that NASDAQ is a more, I don't want to say more important index, but what's going to happen? The S&P 500 is diluted with a lot of things that hold up in a bear market and correction. You have utilities, financials. It's more diversified. So this gives me a little more concentrated look at the market leaders, the tech. So I morphed over all the indicators they use, but I use the indicators that pertain to only the NASDAQ 100. So up top, you have the NASDAQ Composite Index right here. Then you have the NASDAQ new highs, new highs to new lows versus the total number of issues there. Here it is right here. Ratio of NASDAQ 52-week new highs and new lows divided by the total issues trading. And so these were the criteria for the Hindenburg Omen, again, except they use the NYSE and I'm using the NASDAQ. And so you have to have this line both above, actually, yeah, down here on the bottom. You want to see it cross. I don't know if you can make it out of a line there. It has to be above 2.8%. And so here's the triggers. Look at the big drops in the market that came. That one, that one, that one. And you can see for a while there I was putting little dots where these signals occurred, these dotted lines, and they came early on. And there were a couple false starts. In other words, it's not 100% reliable. I'll give it that. But these were little tiny. You can see there, we barely got above there. Here you got above there a lot higher. Might be, again, hard to see in the video. Here you got above it and then you kept going. And so what you want to see is the green line here drop below the blue line. And my blue line's, again, at 2.8%. It's right here. My blue line here is also at 2.8%. And no, I take that back. I put a line at a different marker there. That one had to be below 2.8. And anyways, you can see here we fired off. All the signals are firing right now, and they have been for a while here. See these the 2.8% mark right there. We dropped below. These are daily bars right there. So it's been almost a week now, and certainly above it on the red lines there. So the signal has fired, and it's fired clearly, and it's not a whipsaw. We're really well above the line right now, the red line. The red bars are. And you also have the number of 52-week highs cannot be more than twice the number of the new 52-week lows, blah, blah, blah. NASDAQ McClellan oscillator is negative, and it's certainly negative right there. You can see it crossing red. So, you know, this, like I said, it's been kind of hit and miss over the years, so people have gotten away from it. But that was the, original Hindenburg. This is my kind of my version of it, again, using the NASDAQ. So I just figured I'd share that one because it, if anything, it's kind of like the skew index, which is index that uses, volatility. It's kind of similar to the VIX, similar in a way, but it helps to, it has some predictive value in helping, again, some predictive value in trying to figure when a market crash may come. So anywho, that's it. Just all doom and gloom stuff. But again, forget about that. That's long-term stuff. Trade it as you like. Stay in your longs if you like. But like anything, use stops and just realize that if everything I just spent nearly 30 minutes going over all these breadth indicators do play out as they have historically, then we're looking at an oversized drop here. And let's just call it, let's say, over 20%, and leave it at that. I'll sharpen my pencil on targets if and when we start to roll over on some longer term trend indicators. Right now, as I have mentioned, we have confirmed sell signals, and we have for the last couple weeks on the 60-minute charts. Then last week we got the bearish engulfing candles, which were confirmed on the daily. We have the bearish engulfing on the weekly as of last Friday, but we will not have confirmation on that signal at earliest until the end of this week. So there it is, 60-minute and daily sell signals. Clear to be short right now. We get those weekly sell signals. You might want to add a little short exposure, and then at that point I'll be extending my price targets should we get some additional confirmation. All right, it's been a long one, but hopefully you find some value in these charts, and again, I'll do updates time to time on these breadth indicators. If anything changes, if they start to improve from here, they really couldn't worsen. I mean, they can extend or drop off, but at this point in time, it's already done. What's in the charts is done. It's either going to play out or not. And like I said, so if I see anything else that I missed, I'll get it out to you guys. Otherwise, let's wrap it up here, and then I'll do a follow-up video at the end of the day, or some more individual charts on some of the trade ideas on that I've been highlighting recently on commodities, gold, silver, and treasury bonds, euro, everything else. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.